Hi, and welcome back to Channel 11. Today is Wednesday, July 12th, and we're going to have a mid-year review here with Deputy CIO Jeff Sherman. Thanks for coming on, and we're calling this the haters' ball.
Yeah, hate.
Because there's been a ton of haters out there on the market, and the market just keeps going up.
Yep.
So we're going to review what's going on out there. So we got equities first. Equities are the ultimate pain for the haters out there. Everyone was super negative going in the year. I think consensus was that the first half was going to be a tough year.
Yeah, it was a bad first half, good second half, right? And I think now what we've seen is a lot of people kind of flip that now, right? Because the hate is strong, as you point out. But, I mean, just look at some of those numbers.
Yeah, S&P up 15+%. The Nasdaq's up over 30. The whole value versus growth was in vogue, and value was not in vogue.
Well, just think about it, too. If you rewind the clock back to the beginning of March, we had this stress in the banking system. It looked like the Fed had broke something, right? Rates were obviously having an impact across asset side of it. It was causing deposit flight as well. And it looked like, a recession was potentially imminent. And what do we have? We had Jay Powell to the rescue again, right? So, they've kind of bifurcated this world of they have the interest rate policy and QT. They're running down the balance sheet. But then when bad things happen, they seem to be using these kind of emergency liquidity facilities. And so, like what they put almost $500 billion in the system over the course of like 2 weeks, created all these emergency lending and got us through it. And so, I mean, do you even hear about the regional or community bank being in a crisis anymore?
Not at all. I mean, I'm going to say that we got more negative because we thought lending would pull back. But I think we underestimated two things. One was that the money just seems to be super sticky in the banking system. I just come down to people are lazy and they don't want to move, or maybe they just go into CDs.
Or also people just don't know. I think that's the other thing is we do this day in, day out, right? And, just the financial acumen of the average person in the United States just isn't very strong.
Yeah.
And, again, if you look at your bank account, most banks pay you massively below market rate. And for all of you out there, if you're looking for a hater trade, move your cash, right?
T-bills.
Your cash should be earning money right now. There's government money market. You can buy T-bills, I like to say. Janet has accounts on offer. You go to treasurydirect.gov. Not great for our bond business, right? But you can go get it directly with a social security number. You can own T-bills in a few minutes. And so I think that, the other thing that this does, I think that you actually start to see now that you're starting to feel the effects of the Fed's policy. And so for those people that have moved to money market, we saw roughly about $2 trillion, I think it's like 1.8 trillion or so of new money going to money market. That was coming from cash. So it's not like they sold stocks to do that or sold bonds. But I think that money is dead. And what I mean by that money is going to sit there. People are not going to touch it. It is true savings account. They're earning their 5 handle. They're happy with it. And you know what? They're happy to not consume right now. I know we're going to talk about the CPI report from today, but that's a real yield that's positive now. And so I think in general, that money is going to stay there. And I think now you're starting to see those effects. And it is going to have some drags on the economy. But again, I don't think it's, screeching to a halt, but I do start to think that there are these signs where we are going to start to see the slowdown. So we're still somewhat negative, but I think that timeline's been deferred out a little bit, and it looks like it's probably a fourth quarter to the first half of next year kind of event.
Yep, we got some good slides to show me what that may look like. Here's the Nasdaq. This has been the best first half performance since 1983. Followed by following the worst first half performance. So what goes down must go up, I guess.
Yeah, it's kind of amazing that those tend to happen, right? It's like you get these extremes. That's why I always hate when people say, well, if you miss the top 10 performing days in the S&P 500, you had given up, X amount of return and you'd have missed on so much. But what you don't realize is those top 10 days are usually following some of the worst 10 days as well. So it's these things that markets overshoot, right? And so that's what you're seeing here. Although, I mean, there is some renewed fervor. There's been the AI craze all of a sudden. There's been a lot of stuff going on. And so the Nasdaq is definitely the sweet spot in the market right now. At least it has been for the first part of the year.
That was probably one of the most unfavored parts of the market was tech at the beginning of the year.
Yeah, I mean, it was down the most. We just did the Sherman show. We did our mid-year review with Jeff Mayberry, and we were reviewing his calls from the beginning of the year. And he actually said he likes to buy tech at those levels. So I think he's one of the few people that actually said it.
Good for him.
We just didn't listen to him.
Never buy enough of the stuff that goes up.
That's right.
S&P by sector, kind of the same story. Last year's losers were this year's winners. Tech, consumer discretionary, and then all the stuff that you thought would do well, kind of the safety sectors, things like financials too, have all been kind of languishing. Financials obviously for a reason here.
But also look at energy there too. This was the loved asset class, right? That energy was going to be so strong again, the Chinese reopening trade, right? This was the thematic thing. I mean, there was such consensus on what were the right trades for the year, and it just hasn't materialized. And so again, it's pretty amazing to see, even with that strong June, that energy is still down for the year.
Yeah.
So again, that's oil. Just we joke on the trading desk that it just seems to be gravitating to like $70 a barrel. It overshoots to 75, it goes back down to 65, and it just seems to be stuck there. So I would think $70 oil is enough to maintain margins, but maybe there was too much of that bidding it up last year around the war as well.
Well, as we've been looking at the end of the show on some of those CAPE ratios, energy definitely was one of the more expensive.
Yep.
Relative to their own history.
Yeah, absolutely. And again, that's a lot of people piled into it because of, the Ukrainian conflict and the likes. But, on those relative ratios, I mean, we kept having to extend the chart out every single month because it just kept going through and through the roof as people just had insatiable demand. It's funny, when you talk about markets, a lot of people don't like to buy things on sale. But the one part that I've noticed over the last 2 decades is that energy tends to be a place that investors do buy dips. Right? I mean, we all kind of learned this during GFC and everything, but historically, if you go back, you'll see that money tends to flow into the energy sector kind of year in, year out. It's just one of those that kind of stands out.
Yeah. All right. Well, fixed income today, if you started this year, a lot of research from the street was all about the year of the yield. And I think it's kind of been a year of carry. I mean, the 10-year sold off last week and it's rallied back to basically unchanged on the year, 385. The 2 years higher, 2 years started the year 440. We're like 475, 480 today. So you're basically kind of earning your carry. This was printed as of July 10th. Here we are on July 12th. This is all stale now because rates have rallied pretty significantly. So all that stuff on the left-hand side that's more rate sensitive, treasuries.
Yeah, another point or so, right?
Add a point to it. And they started the year yielding like 4. So you've kind of earned your carry through the year. And this stuff that's winning is what everybody was hating on. Credit, right? People were hating on riskier credit. Everyone's like, buy IG, don't buy high yield.
That's right. Yeah.
So avoid bank loans. And guess what? Bank loans, CCC bank loans are one of the top performing sectors, up 670. You got BBB CLOs up 7%. I think BB CLOs, which are not on this graph, are up almost double digits.
They're double digits, yeah.
So basically, credit has won, and the haters are wrong.
That's right. And this one of our CLO traders said in the first time in his career, he saw an investment grade rated CLO tranche that had a double-digit coupon.
Yep.
So he's bought them at yields before at those levels, but you slap on the SOFR with the spread, it actually had a 10 coupon the other day. And so there is yield still out there. There still are some interesting things. And you can see here, too, it's also duration. Right, the stuff that's done the best here is the shorter duration asset classes.
And here we are looking at Treasury curve, the 2-year. This is on a daily close basis. We actually broke through the 2-year high. We got all the way up, I think, to like 515 on the 2-year intraday on Thursday after that ADP report. And then the 10-year, we've been looking at this chart with this line. Last couple channel 11s, we had been saying don't get too cute. If we get past near that line, which is around 390, it was a good buying point. Got all the way back up to 405. We bought some 10-year treasuries ourselves, and it looks like it's worked because we've rallied back down below that. We're back at 385. So
yeah, in these markets, I'll take a 4-day trade as a win right now too. I mean, again, especially how painful that day was with the ADP report. We just kind of held our nose and bought a little bit. There was some doubt. There were some haters on the desk too, right? Even though we had established all these lines that this is where we're going to do it. It's like, I remember one guy, and I won't call him out by name, but saying that, the 10-year is going to 550. In the next couple of weeks or so.
Super cheap.
Yeah. So 550, we'd buy a lot more. But again, that four handle, we just weren't sure we'd get back there. And again, we're having trouble getting back above it again right now too with the CPI print today. So,
well, what's really happened is real yields have come up a lot. The last time that when this started back in 2021, it really was one of the things that was hurting equities, right? With the rise in real yields. But here we are with the highest real yields we've seen in and since the global financial crisis, basically.
Yeah, but if you look at that repricing, you can see what happened there too. So although the yellow line, the 2-year, is significantly higher, I think people really think of 5s, 10s or longer just because, again, the equities being a longer duration asset. But you kind of see that movement. It's really exacerbated on the 2-year part of the curve, but really the rest of it's somewhat moderate. Yeah, it's kind of sideways-ish. So I think if you saw another push up, you saw another 30 or 40 in real yields, that would be problematic for the equity market at this point. But again, I think there's so much negativity got into the market. Now, we also have the challenge now, the multiple is looking pretty rich as well, right? I mean, you talk about, if you look at a CAPE ratio, you got a 30 handle, right, on the CAPE. You look at with the optimistic kind of forward-looking guidance, it's like a 21 PE right now. So a lot of high-flying stuff, or what's done really well, are the high multiple stocks as well. So again, I think I could see more sensitivity coming if we backed up here, but I think there's just a reprieve to see where the inflation print came out today, and I know we'll talk more about that. But in general, I think that I think equities do need a little bit of a breather here, at least, or some rotation, and we've seen that a little bit, right? If you look like the equally weighted S&P starting to catch up all of a sudden, and so you're starting to see a little more breadth across the market, at least over the last 3 or 4 weeks.
Yep. All right, we got the commodity index on the right-hand side. A lot of people bullish on commodities last year. They did really well, and not so many people hating on them, but it's been a week.
I mean, that looks like a downtrend to me. I mean, looking at that chart on the right-hand side, and again, even with the reprieve we've seen in the dollar, but last year was kind of one of those abnormal years for commodities where you saw a rally in the dollar and you saw commodities do very strongly. And I think a lot of people thought about, again, this Chinese reopening, extrapolating what the developed world did post-COVID and really reopening the economy. You haven't seen the same thing happen in China. I mean, China's actually having to stimulate right now, right? And so that thesis got kind of blown out of the water in the first half this year. And I think part of that is the commodity market as well. And commodities in general, as I said, the oil price it kind of just gravitates to 70. We've seen this on the industrial metals side as well. Even with all the, electric vehicle production and these kind of longer term kind of secular bullish stories for commodities, they just haven't really panned out this year. And I think a lot of it can be blamed on some negatives. Yeah, I mean, we're slightly negative here too, just because, again, we're looking kind of as we think about, where we are in the cycle. And again, just that thesis of thinking about it is going to be a slowdown. It probably starts in the fourth quarter. There's a multitude of reasons. I think Fed policy is one, but more importantly, there's this one little kind of thing that a lot of people have been talking about, and it's the resumption of student loan payment. And so I think you mentioned this in the meeting the other day, is that, well, look, they have been. And look, it's a big deal. If you haven't made a payment in 3 years, you forgot. I mean, if you haven't made a payment on something, Ken, and you're an astute finance person, right? You probably forgot that you made that payment, right? That it exists. And so all of a sudden there's a rebudgeting. But as someone said, that's why I was attributing it to you, but it was someone on the team recently just said that, what are they going to do? They can't repo your degree, right? So, if you're going to pay something, you're going to prioritize what's important. It's your car, it's your home, it's a place to live and drive around. So, again, we'll have to see how delinquencies go. We're starting to see some stress in some of the ABS sectors on some of this, but, again, it's not something that's saying a recession is imminent because of that.
Here's commodities, the only winner being gold. And in the big scheme of things, people say buy gold when there's inflation. Stocks have done better.
Stocks have done much better. They've repriced. And also gold, gold just got struggled around that 2050. Right. Also, remember, gold caught a pretty strong bid during the banking turmoil, and then it's really dissipated since then as well.
Yeah, and like when T-bills yield 5, why send gold or 8?
Exactly. And again, if you're a gold investor and you don't own the physical, or you don't own the Cougarons or whatever you want to invest in, you have to pay the carry, right? Futures trade based on T-bill yields. And so effectively, it's what we call contango in the commodity market, but they trade in a full carry model. So that means, in general, if gold price goes sideways as a futures investor, you will lose that T-bill return over the course of the year.
Better to earn 5 than lose 5.
Always one of my mantras. That's a 10-point spread that I'd like to collect all the time.
Terminal rate coming back up.
Yeah, when you sent me this chart deck, I saw this, and for some reason, I just started thinking about bugs. Terminals and clawing. I thought it said actually Terminex and crawling or something too. But look at that. I mean, look at the fervor that has really dissipated from the market. And I think it's very important when you look at this, because think about it. The Fed has now told you that they want a 50 basis point higher rate than we have right now. That's in the dot plots.
Yep.
What was it, like 11 plus governors had at least a 50 basis point hike between now and year end. And the market has it priced even fewer, right? So
the market's been like consistently below.
It's been consistently below. It's fading it.
And except for right before this SVB incident in March.
Yeah. And I mean, look, this is also, remember, inflation was 250 basis points higher 4 months ago, right? When we were getting those prints too. And so there was a different world. So I won't front run the inflation section. But.
Well, here's another view at it. So on the right-hand side, you've got implied market rates through time.
Yep.
And look at this is 1 month. If we made this 3 months ago, it would be even more dramatic. I mean,
it was super.
At one point, I think the market thought would be at like 4 by then.
Yeah, I think there was 4 cuts from that point.
Yeah.
I think that was like peak turmoil out there as well. But I like how you had the 2-year on the other side as well, and on the left-hand side. And so, if you look at where the 2-year is, it just says the market doesn't believe that the Fed is going to be at this level and maintain it. The market will give you the idea that you can hike, but ultimately you're not going to be able to stay there for a prolonged period of time. Now, again, the bond market gets a lot of credit for being forward-looking, and it predicts all these things. Bond market investors are just as bad at forecasting as equity market people. It's just our markets move a little bit slower, so we're not as extreme in being wrong at times. But I think what I'm pointing out on all this chart is that the 2-year is telling you that it doesn't think you're going to get there, and I think that's right, is that you just can't stay there for a prolonged period. But, it's not that, you see that cut on the back end, and it doesn't mean that the Fed's going to give you one cut at some point. It's people playing, maybe there's a 10% chance of a 200 basis point cut or something like that, right?
Yep. I think the slowdown is just taking longer than people thought because there's so much fixed rate debt out there. We have this huge fiscal stimulus that came through that I think,
and it still exists. You can still get some of these income credits today. I mean, there's a lot of scams going on with the, you read, there was a Rolling Stone article that was pretty good about it this week that came out. But ultimately, I think it's the fixed rate debt, as you said, but this is what's happened with corporate America. We talked about at the beginning of the year, right? That the hikes weren't in the system because it's only at the margin, right? It's only debt that comes out that has to be refinanced at current rates or financed at current rates. So irrespective, the weighted average cost of capital is still quite low. Time kills this argument, but for right now, that's what we have. And like we've been talking about on the desk too, right? About, the lack of issuance in markets too, because if I don't need to come to market,
you don't want to borrow at 1%.
Right, exactly. And don't forget, we talk about market rates, we're looking at Fed funds, but don't forget, if you're going out and originating a loan and you pay prime is 8.25. I know we always talk about SOFR and these five handle yields, but prime rate, and that's before you slap on a spread, is 8.25.
Yeah, so
that means
small business, you're borrowing at like 10%.
Double digits, right? And so that your project has to work. And so that's why I'm starting to feel like that's the part of the market I'm looking at, is that small to medium enterprise, to see if there's going to be cracks. I think that's where the cracks really start to see. And even as you show the strong performance in bank loans, there's a lot of really hairy credits in that CCC bucket. And so, again, I wouldn't get too excited about seeing that performance and trying to extrapolate it, because these are things that already yield close to 20%.
That's right. So it's been a strong 6 months. We go back 18 months to the disaster that was last year for financial markets. And you still have a lot of negative returns out there. So there's not many things that are, since the end of 2021, that are up. You got to go all the way to the far left-hand side. Commodities,
right?
Surprisingly, they just had such a big year last year. They're still solidly up on the year. And the FTSE, I guess that's Italy, right?
Yeah.
And gold has done okay. Everything else has kind of been still down.
And I think emerging market bonds are just barely negative, it looks like right there. So,
all right. So we have this. We use the same picture last month, but this is the hater. This is Johnny Hater over there looking for the recession, looking for stocks to go down, looking for bonds to work, and it's not happening yet.
And you know what? He's got all those storm clouds just sitting there.
All the data, LEI negative 14 months in a row.
All he had to do is turn around and see that there's the land of gains behind him, right?
Okay, this is, we're going to thank Jim Reed at Deutsche Bank. He put these charts together so I didn't have to. Yeah. So thanks, Jim, and your team. We love the work that you do.
Yeah, I said it to you, too. You said, hey, there's a lot of good charts. And I said, I was going to tell you exactly the same thing. And I said, and by the way, his commentary when he put out his chart book said, this is to help you guys write your mid-year reviews. And I'm like, he knew what we were doing. Thanks, Jim.
All right, so this basically assumes that you're 6 months from the recession. There's all these data points, and we create charts like this ourselves at DoubleLine. I've had a couple on the show, but this is the S&P 12 months before a recession. Usually, it kind of goes sideways, but you could say that it's we started kind of off a big sell-off, and so if I take this back 24 months, we're kind of at the same point that you have been historically, but we just came from a higher point. And what you'll notice, and I guess the takeaway from this is that equities don't sell off till literally right before the recession starts.
Yep.
So it's 3 months based on historical data. So you can't, it's hard to extrapolate equity performance. It'll be too late by the time the recession happens.
And then by the time you're down 20-25%, it's time for the recovery, right?
And stocks go down faster than they go up.
That's right. Absolutely, yeah.
And
then the haters will be right when that happens, but you'll just say, look, let's look at the cumulative performance of that period. And you can see that you left a lot of money sitting on the table.
Totally. This is equal weighted, looking kind of more in line. We're, basically right in line with historical averages going back since 1945. And same thing, you can see that the sell-off really doesn't begin until right before the recession starts. So if the recession is going to start, let's say 6 months from now, as this points out, which kind of jives with when Fed's favorite, the Powell's favorite inversion, which is the 3-month 10-year, that inverted in October of last year.
Yep.
So usually after the inversion, 12 to 18 months is when the recession starts. I think it's like 16 months on average.
Yep.
Which puts it
right.
somewhere in the first quarter of next year, which means equities probably have room to run until the end of the year.
Yeah, and I think, like we were talking about lack of issuance in the bond market, people are going to use credit spreads as a proxy as well. And you're going to look at the credit markets, and I'm sure we'll look at that next. But you look at credit markets, they say there's really not much problem right now because there's money chase in the asset class. There's a lack of issuance of new supply out there, and so it just pushes the price up. And so I think those two things are constructive for credit and equities in the short term. And I think, over the course of the summer, you probably have, the momentum behind you on this stuff, and at least till you see some weakening in the economic data.
Okay, 2s10s. This is 2 years before recession. And we started off pretty aggressively inverting, or that move happening, and now we're kind of average. And the other thing you'll notice is this doesn't really start de-inverting or steepening till after the recession's already started. So by the looks of this, like you kind of get maybe your cut or two, and then aggressive steepening. So we were talking about today, at some point in time, you have to put the steepener on where the front ends are going to fall because the Fed's going to cut, but maybe it's too early, but it's kind of on the horizon.
Yeah, no, I mean, look, that's what we've been talking about is, we bought our duration, late last year, like let's say the fourth quarter-ish of last year, let's call it post-summer last year. We did it mainly on the back of the curve. And the next place that we've been talking about is being kind of in that front to belly of the curve. And I think, and when we buy it, I think the 5-year point's going to be the part to buy. As we've been seeing this kind of week, you're starting to see that part of the market can really outperform. And again, you get more duration.
Even off Thursday's highs, the 5-year is down like 40, 45 basis points. So it's been a big move already.
So we don't want to chase it right now, but I do think as again, you see this inflation data, we get the Fed in 2 weeks. They hike that meeting. It's like a 90+% probability. One of my analysts today was joking. He's like, is your screen working all right? Every time I look at it, it says 88.8% chance. And like, we were just refreshing it all morning, and I finally went to like 92. So it is working out there in those probabilities. But ultimately, I think that you could see like the 2-year getting a little bit more pressure upward. And I think maybe we retest those highs.
Yeah. Okay. So this is inversions. And it's a weird thing. They take the dark blue, they take the inversion, and they multiply it by the number of months it's been inverted. So the magnitude of the inversion. So I guess it's to kind of try to normalize between time periods. And then it shows you the peak to trough GDP drop. And the point they're trying to make is the level inversion doesn't necessarily have a correlation to how bad the economic drop is, right? Yeah. So don't read into like, we haven't been this inverted since like 1970. Like this is going to be a real bad one.
Yeah.
Historically, it hasn't really mattered.
Also, it's a lot different in 1970. Your inversion, when you have a front end rates like 18 and your 10s are at 16, it's a lot different than, having front end at 5.5 and the 10s being at 3.5, right? And so there is something about that, the magnitude of that as well. But I think some of it is just that also, look, people didn't think we could get rates as high as that they have. The Fed's been successful in doing that. And so I think what you saw is a lot of people step into that trade. And then again, we've kind of held these levels. So for as volatile as it feels like the Treasury market's been, as you rightly pointed out, we barely moved for the year at this point, and there's just been vol around the range. It's been like about a 40 basis point range.
Yeah, at the beginning of last year, I think most people thought the Fed couldn't get past 2.5.
Right, and that's because that was the last cycle, right? So we're all kind of short-term extrapolators, right, when you think about it. And so I think a lot of people have never seen rates like this. Like I was joking about the CLO trader, right, saying that he's never seen a double-digit coupon on an investment-grade credit. Things are just different, right? And this is what happens when you have some level of inflation. And, I think that, there's nothing magical about 2%. The Fed's adopted this target for like 20 years or so, or a little inside of that. But there's nothing magical about it. And like if you go back to 06 and 07, inflation ran with a 4 handle. It was not a problem, right? I mean, there was other problems in the system, but you can have some level of inflation. And I think really the next step for the Fed is that they're going to dust off the playbook we saw post-GFC where they started talking about nominal GDP targeting. Because they're going to say, well, look, they're just trying to manage exactly to some number.
Inflation's going to go up and down.
It's going to go up and down. Let's just look at nominal growth. That's what we're going to try to target. And you know what? Nominal growth is how you erode your debt pile. And so they'll take some level of it. Is there anything wrong with having a 3% inflation? If you get 3 growth, we probably don't get 3 growth. Probably get, 2.25, 2.5. But, 5.5 to 6 nominal, I think the Fed would take all day long.
Yeah, the other thing this chart shows is that, again, going back to 1945, that every time that we've had an inversion, except like I think one time period or 2 time periods, that there's always a recession. So it's a very, very strong indicator.
Yeah.
Going back through time, as Jeffrey always says, you have to respect the yield curve.
Yep.
And that's why
although the inventor of it, supposedly, it's Cam Harvey, when he did his PhD thesis on it, he said, well, maybe it's not the case this time. He said that last year. Now he's starting to say, yeah, it's probably the case again. So I give him kudos for like being adaptive in his thinking at the time as well, and say, yeah, there's probably a lot of pent up stuff in the system right now. But now he's starting to say, yeah, you need to pay attention.
Yeah, so we've been super patient. Like we slowly decreased our credit risk, and we're not like, chasing, credit assets and chasing risk here.
And also we're not selling right now into this because again, we think there's technical reasons for the short term. And, look, you're never going to get exactly right on when to lighten up. But, like I said, I think that the data, like you look at the ISM services from last week. I mean, that report, every aspect of the services channel looked appealing, right? You had prices paid coming down. You had employment up. You had the services up in general. I mean, the haters couldn't do anything there. And then the haters come out and say, well, look at manufacturing. It's like manufacturing has been in the basement for 18 months right now. Yeah. So ultimately, there's a lot of
services economy.
We are, right, and that's again, you can take all your studies back, but the economy changed in the last 25 years, and that's really when you get the data on services. And so, in general, as long as people stay employed, the economy is going to hum along, and we're going to spend money. But I'm just getting a little bit more concerned with seeing how much money went into money market. I feel like at those rates, I think that money's stuck. And so I think that is the propensity to consume at the margin is slightly low.
I also just saw today that there's studies that show you the pent-up savings from the stimulus checks was about $2 trillion. Now it's down to about $500 billion. Yeah. But most of that $500 billion is, upper wealth or higher income bracket, and they spend less of their savings.
Right. Yeah. The wealth effect doesn't work. Right. Yeah. I mean, the trickle down doesn't work. Right. Because once you have so much wealth at some point, you don't need to go buy something else or if rates or anything like that. And they're very happy to earn on that. But the other thing, and I didn't think it got really enough coverage, was that if you look at the Fed's measure of credit extension, it's some of the lowest levels we've seen in the last couple of months. Right. Where it was like 23 billion the previous month. It got revised down to 20, which, okay, that's not much. But the expectation was 20 for this month, and it was only 7. And so if you're starting to see more of this credit slowdown, credit creation, it's bad for our system. And that's why I think we got pretty negative around the banking system. We said, look, if the data gets support, we'll change our mind. That's what we've done. Where we say, okay, we're not changing the positioning. We're just saying, okay, let's slow play it a little bit more. But ultimately, if credit slows down, that's what chokes off the economy. And so we're levered. That's just the way the economy is. And so these are all signs that we're kind of watching in our radar. And, again, you did see finally money velocity or money growth, the money supply actually picked up. it's not shocking with all the T-bill issuance and restocking the Treasury accounts. But in general, you are starting to see some of that slow down. And so again, these are just things that have on the screens. We update them each month when we get the new data. But again, it doesn't say that a recession is imminent, right? And that's probably why you see some of the fervor for credit and equities as well.
All right, this is triple B spreads before the recession, and just like equities, they don't really turn until 3 months before the recession starts. So don't look at high yield spreads as I know a lot of people say, oh, you got to watch high yield. When high yield sells off, then equities are going to sell off, which is true. But again, it's not the best indicator based on.
And I also think, we've been talking, and you've had Robert Cohen on a lot. I had him on the podcast again recently because I wanted his updated thinking and just about credit in general. And, look, he talks about the quality of high yield, right? You have a higher quality asset in general. The ratings are higher. They've migrated up. The interest coverage is pretty good. The debt cost is low, right? So that makes the interest coverage good. But also, they don't have to refi. So that's where the problematic market is loans. And so everybody likes to use high yield. I think everyone should be focused on loans in this cycle because of how rapid the rate hikes have been. They're the ones that actually feel the pain on the coupon.
Yeah, I mean, the average spread on the bank loan index going back 10 years is like 500, and SOFR is now over 500 basis points. So their cost of debt has effectively doubled in the last year or so.
Yeah, thanks, Jay.
Okay, so unemployment. I know everyone's obsessed about the jobs report, and they're looking at the jobs report, but guess what? The jobs don't go away until the recession has started.
I like to always say companies don't lay workers off because they think a recession's coming. They do it because either their businesses are in trouble or they have it already, and that's why you see those big take-ups there.
So a lot of people that really follow that jobs market data, it's like it's really kind of lagging, right? So it's not a good indicator. You gotta look at everything else and try to foresee.
And there's the haters are out there a lot, birth death models and stuff, how they try to estimate it, in the private sector, and it's just like, I don't know. At some point, you just have to say like the data is the data at this point. And look, we can rip it apart, but if you've been relying on the birth death models and that's what's keeping your negative view, it's not helping you, right? And so that's why you have to have an open mind to some of this as well. And so that's why I like to take it in. We like to look at it, but don't get too wedded to one single kind of theory out.
Well, for every data point, you can find a bull and a bear coming out with their view based on that data point.
Right. Well, I mean, look at the jobs report. It was exactly that way. And I think the one subtle thing about not the ADP, but the establishment household surveys is specifically the household survey. This is why you saw the unemployment rate come back down a little bit from 3.7 to 3.6, where it ticked up from 3.4 to 3.7 the previous month. Is you saw some resumption of these self-employed step back in the market. It was weird. That's why I said, was the last report, the previous one, was that an aberration? Because we lost like 500,000 of self-employed people, and it was just scratching out like, how can that be?
Yeah.
And so again, the data seemed to offset back this last period. So maybe there was something kind of funky in there as well. So again, it's one of those things where when the data changes, you've got to change your mind.
Yep. All right. Fed funds before recession, they cut 3 months. 3 months, the magic number.
Yeah.
Well, it kind of makes sense. It's like things need to get really, really bad, and they start cutting,
and then it goes meaningful. Look at that one extreme. Like one time back there, they cut 700 basis points in 18 months. So you thought the 500 in 16 months was crazy, Ken?
Yeah.
Well, look, you can reverse it very quickly as well. So
there's also that big spike. One time they went up 800 basis points.
I think that was Volcker. I got to think that was the Volcker era because they were mired in these recessions and they were trying to really fight it.
They did it again, like 16 months out.
Yeah, well, I mean, that's Volcker was the original hater, right? But he gets a lot of kudos these days. So sometimes the hater becomes the champion ultimately.
All right, LEI, we've been talking about this a lot. It's been super negative, but it started off really elevated. So maybe because we had so much of that fiscal stimulus come through, that LEI is kind of really weak.
Yeah. The other thing I see in this chart too is that it's really stayed persistent over the last few prints, right? We just stayed mired at this level, and this level is consistent with a recession, right? Where we're at here too. So I don't dismiss this chart yet, but I do agree that again we had all this stimulus, all these things overshot to the upside. They should overshoot a little bit to the downside, but definitely this is a chart that always circulated. when the LEI report comes out, it always comes across the desk, right? Everybody talks about it.
Yeah, I don't know. It just seems the timing relative to when that three-month 10-year inversion happened in October of last year, 12 months out, puts a slowdown starting sometime in the fourth quarter to the first quarter of next year. So I don't know. I feel like don't get too bulled up just because the markets are up.
No, that's the thing.
Valuations are more expensive now.
The only thing that's changed is the price, right? The data hasn't really changed much. The price has changed, so you really shouldn't change your view on it meaningfully.
Commodities actually go up a lot into the recession, probably because economy is growing and the Fed starts hiking because inflation's running hot. And this time it was kind of a different story, right?
You also have historically a lot of times that we've been thrown into the recession due to spikes in oil prices, and so look at, and now this is the Bloomberg index, so it's not as heavily weighted to energy as something like the S&P GSCI, but ultimately that's usually some of the choke points you've seen there too. And so again, the commodity market has been kind of there hasn't been just like these stellar performers or something that's causing stress. Remember, 2 years ago, everybody's talking about lumber prices and all these kind of one-off commodities that aren't really in these indices as well. But I think that the key thing to watch is foods. And even if you look at the CPI report today, the food away from home is still kind of a number that's really disconcerting. It's like 7 to 8%. So you're starting to see that still on the food side.
CPI going into a recession, just note that it typically doesn't drop till after the recession starts. So
it's kind of weird, right? That so what? We stop spending and we stop inflating. Wow, that kind of makes sense.
Yeah. So I mean, on this note, it's been a pretty big drop in CPI, at least headline.
Yeah, and I mean, look, we got another report today. Now it's 2.97, so we got the 2 handle, although it's rounded to 3. But the good news is that it's positive, but the bad news is the roll-off next month is a 0.
Yeah.
So if there's any signs of inflation ticks up next month as well. So again, I don't think that this new report with a 2 handle, it changes the Fed's thinking. I think they're hiking in 2 weeks. The question is, should they or shouldn't they? I don't think they should, but I think they will. And ultimately, I don't think that this changes their mind whatsoever. And they're going to wait to see what they do in September. And I think you only get the August inflation report. I don't think that the inflation report comes out before the next Fed meeting. I'm not 100% sure of that, but but you do get 2 jobs numbers, right? And that's going to be something their eyes are on.
Here's the haters' favorite number here. ISM manufacturing been negative for quite some time.
I said almost a year. So I said 18 months, but it's only been about a year or so. But look, we've had a lot of head fakes in the manufacturing too. I like to overlay, the manufacturing and the services from the ISM. And what you see is that we've gotten a lot of head fakes of it being contracting inside of manufacturing. It doesn't lead to anything. But if you get both manufacturing and services, and we got very close a month ago in services, but if you stay mired there for a couple of months in services, I think that's a very strong indicator that things are really, really slowing.
Now here's services, like you said, it dipped below about a little less than a year ago, picked back up, and now it's been coming down too. So we only have 3 data cycles, so 3 data points. So
yeah.
This is not as robust as
the manufacturing, right? Yeah.
But this doesn't really tip over till the recession starts either.
So. Well, it's also because that's usually you're in the recession, you have job losses, then you have to consume less, and the first thing you cut are services, right?
So last 2 charts here, we've seen these before. I just want to point them out again. This just shows you the budget deficits through time before recessions, and look back into let's just call it post-World War II. You had these big, these wider gaps between recessions.
That's because we created the Fed, right? So we created the Fed, early in there around World War I.
We also started using more fiscal stimulus, and the deficit was going higher. So bigger deficits, more spending, more growth.
And there's just better data now too, right? We can monitor the economy a lot differently. Like in 1875, how are you figuring out what GDP was? You had to wait for the almanac to come out to see what happened, right? So I don't know if Merriam-Webster was around. What were the almanacs when we were kids? It was one of those too. But
look how big the deficits got. So this just shows you kind of like how much is slushing around in the system from the fiscal stimulus. So this is one of the things, and this is again from DB, that maybe all this stimulus is why things aren't as bad as people thought. And here's that excess savings. DB forecasts it to be gone by the end of the year, which is why their recession forecast was for Q4. they're thinking right now about pushing it back to Q1, as is everyone else, because Q4 is almost here.
Yeah, no, I mean, and it's hard to say that a recession's imminent. And again, there's a lot of data that you can argue that the recession is on the horizon, but nothing out there tells us that it's imminent right now. And I think that's the reason you're seeing that. And look, all eyes will be on earnings this week. We get the bank start at the end of the week. It sure doesn't feel like the earnings are going to be bad.
Yeah, it seems like they're gonna be okay.
And everybody's going to talk about AI and how AI is improving their profit margins, and the world's great again, right? So
off to the races. All right, we're going to end with some what's cheap. This is a percentile rank of yield. Of course, with yields near 10-year highs, yields are looking pretty good everywhere. There's literally nothing that's sub 90th percentile. High yield looks the lowest with the big rally that it's had at 93rd.
I mean, it's pretty amazing, though, when you look at that, right? Everything is in the top decile of cheapness, but this is yield, not spread, right? And so, some of this, I think, is a little bit, because you look at high yield, it's like, wow, it's so cheap when you look at this. But, I've made the argument, too, that, like, at spreads, what do we, like, let's call it 400, right, on cash bonds. At 400, that sounds, okay, that's reasonable. 500 is kind of the average, right? That's why CDX trades there, or prices off of that. But it also trades on the 5-year part of the curve. And we know because of the inversion, too, well, you get another 100 on the front end. So I actually think high yield spreads are tighter because, look, why take any risk? If I can get 5.5 risk free, does it really make sense to be getting 8.5, right? And so at the margin, I mean, look, I'd rather have 8.5 than 5.5. I get it, but you do have to take a fair amount of risks to do so. But again, I'm willing to dance there right now because I just think there's technicals over the course of summer, as we've already mentioned. And I think you want to be selling late into summer into some of this, assuming that the data does not improve.
And so that's why we look at the spread chart. This shows more divergence. IG and high yield had cheapened up a lot. Last month when we looked at this, they were up at the 70th percentile, and they've both been ripping. So now they're 50th percentile. And agencies still look cheap. They've looked cheap for like the last 6 to 12 months.
Yeah, they continue to be. But it's funny about the IG and high yield too, is that again, this is where you had a lack of issuance once again, right? And it's like money's chasing it, and at the end of the day, people want the high quality, but then they're saying, wait a second, look at how well high yield's still doing. And so it's like, I think people are splitting the trade, right? I don't think they're just all going and hiding on that front end, or the higher quality asset as well. But yeah, I mean, the agency market, I mean, look at that, almost near the cheapest it's been in a decade.
The agencies are the haters to corporates. They've been hating on corporates, saying, why buy corporates when you can buy agencies?
And the corporate guys are saying, because we're winning. Yeah, they're hating right back, and that's what's happened. And believe you, we have these discussions here at DoubleLine. And
we're a big securitized shop. We're always
talk about it. And our corporate folks are out there saying, man, we want some love. Look at what we've been doing. And they've done a good job underwriting and getting through the cycle as well. So, and so kudos to Cohen and his team out there. Also, kudos to our securitized teams for keeping us in the game and some of this stuff as well. But look at that stuff. You tell me there's not cheapness. Look at those BBB CMBSs. By the way, those aren't going to be BBB for long.
Yeah.
Now they're on their way to downgrade. Our team says probably like 5 notches or so is probably the first step. So, that's putting you solidly into like high single B.
Yeah.
But, think about it. Single B 1,000 over. Single B high yield today probably trades 500 over, maybe 525.
Yeah.
So, I mean, there is still some value there, but we all know that there's going to be a lot more headlines to come there. And if you want to see anyone beaten down, just go a row over from you, Ken, and go talk to the commercial guys across the way from you. I mean, they just every day, I just feel like we got to give them some sunshine. So
that's right.
Yeah, they're not the haters. We try to go give them some love. So.
All right. And with the Cape, I'll let you talk about it since it's your baby.
Yeah. So, I mean, as we were talking about this energy, I was chatting with some investors down in Chile a couple months ago. We were down there, and the guy said, this is the only metric I can find which actually makes energy look expensive. And he's obviously long, right? He's obviously long. He's getting beaten up on it. He's done the value rotation. They're long the China. I mean, they just had a very highly correlated trade. And I said, the thing is that ultimately, we got way ahead of ourselves, right? I mean, the price action just got there too much. But as you see on the bottom side, there's still stuff that's very cheap. We've been out of tech in our sector rotation product on the Cape strategies. We got out of tech about 3 months ago, so we've missed some of this rally. But the good news is when we did, we got into the consumer services down there. I say consumer, it's communication services. There's a little screen blocking me up there. I couldn't see it right. But the communication services actually has benefited from this kind of tech rally as well. And so it's done pretty well. And you can see that in terms of just the valuation change there. A lot of that's just price action that's driven that up. So the strategy has done relatively well for, kind of getting away from the highest performing sector of the market. And, again, as we talk about valuation, everybody's focused on the Magnificent Seven. I think that's the new phrase I keep you. Yeah. And it must be great to be an analyst to come up with these clever, quirky names, for these things. I don't think
The
anything
highlight
that's,
of their month.
well, like the guy who came up with bricks, right, from Goldman. I mean, we used that forever, right? But I think what you see there, just to get out of that one of those sectors and still be able to hang there, because the valuation is getting high. I think that I saw something that, forward 1 year earnings, like the multiple's like a 40 handle at this point. So I get the hype, I get the, all the fervor around AI. I'm just not completely convinced either, but I'm kind of a Luddite too. I barely talk into my phone, to tell me what to do. So, but again, we've been able to rotate through all this stuff, and it's not always what you own. It's also sometimes what you don't own. And that's not only energy and, some of the Utes, and as you saw, those are the worst performers of years. It's been helpful to us in the strategy this year.
So that's it for this month. Hope you guys enjoyed the haters ball. Yeah. The haters are not winning. The people that are long risk are enjoying the land of gains. Hopefully everyone owns some of that stuff too. But, there's some signs that things are slowing. So, play it safe too.
I think it's balanced at this point, too. And it sounds like a very weak thing. We're paid to have views and stuff, but it feels like you want to be balanced. We had a strategy meeting yesterday. We were talking through it, and it's like, I don't want to cut credit at this point. Like, I still think we need to own less by the time we get farther in the cycle, but it sure feels okay for the time being. And, we have the duration in the portfolio, and, that's adding as a ballast to the equity side of the market as well. So in general, I think asset allocation is still extremely important. And I think, again, the haters will have their day in the sun out there, but don't forget, it'll be short-lived too. You want to become a hater when it's in vogue, but you got to leave that area too, because markets tend to go up over the long run.
All right.
Yep.
Thanks, everyone. Good luck out there the rest of the year. Take care.
All right. Thanks, Ken.